Hello, welcome to day 6. Today's going to be all about central banks. This is one of the biggest money making opportunities of the month. As long as you're prepared, there can be some great opportunities. Ultimately, the central bank is one of the most powerful institutions in the markets. They're the ones that control the interest rates, and that has a huge influence on pricing of all assets. So this is one of the big ones. Okay, so with the central banks, we're going to start off by looking at the roles of the central banks. This is going to include monetary policy, the tools they use to implement it, and also some of the more extraordinary measures that we've seen since 2008. They've become a lot more prevalent, so we'll explain some of those. We'll then move on and have a look at the major central banks. I'm maintaining this down to just 3. I'm going to look at the Fed, the ECB, and the Bank of England. Reason for this is we could go into all sorts of different things on many different banks, but keep it to the European hours, the hours that we predominantly trade here, and they're the main, some of the very main banks anyway. So we'll be focusing on those and then trading opportunities. This, of course, is why you're here. This is what we're looking for. Where are the opportunities for the central bank? And that's going to come from the meetings, the actual decision meetings and when they release the decisions that they've taken, speeches and comments. You get ad hoc events throughout the month, which you've got to be aware of, but they're not so clean cut as the meetings. And of course, we'll have a little look at the ECB preparation video. We go through all of these in very great detail each month before each central bank comes out and gives its decision for that month, so you'll see how we get our prep done here. And finally, a little bit of trader development. We'll have a little quiz for you. Oh, I'm sure you're looking forward to that. I'll give you a little bit of history, but ultimately this doesn't help you money, so we'll move quite quickly through this. Central banking did start in 1694, started in England, and to continue with the 9 Years' War, the government needed to borrow some more money. They, at the time, were quite poor on their creditworthiness because they've been spending a lot of money on the war. So what happened is a group of individuals said, yeah, we will lend you the money. And for that, the government gave them the right to then issue banknotes and basically become the government's banker. So they would buy the government bonds from the government, thereby giving the government money. And this comes into how a central bank actually earns its money, and this is done through a couple of ways, but ultimately they will buy the bonds from the government because they're issuing the money. So they will issue the money, buy bonds from the government, and they then receive interest on the bonds because essentially they're lending money to the government. Beyond that as well, there's also the commercial banks that operate within their jurisdiction. Commercial banks will have to hold or will hold deposits with the central bank, and these deposits will earn a degree of interest on them as well. The term for lending the government money and earning the receipts on it is seigniorage, not something that I imagine you're going to hear a lot of at all in your trading career, but just a little bit of history for you. Moving on to what the role of the central bank is. In some countries, it's to supervise market participants and the financial markets as a whole. This varies country to country and their degree of regulation of banks. If you go to America, you have the SEC that does a lot of the regulation. In the UK, you've got the FSA and FCA as well. So it does vary quite a lot from jurisdiction to jurisdiction. Beyond that, the real role of the central bank is setting of monetary policy. This is interest rates and money paid to banks who are holding deposits with them. And there's also the additional element of managing foreign reserve accounts as well as gold accounts, and also in some countries' cases managing the exchange rate. This was particularly prevalent with the Swiss National Bank, who had a peg, so pegged currencies. The central bank would usually try and maintain that exchange rate. So let's move on. Monetary policy is the main role of the central bank, so that's where we're going to focus. Now, the idea of monetary policy is to control the supply of money in the economy and also the cost of credit. Now, the reason the central bank will do this is because it influences inflation. If there is a huge amount of or a huge supply of money in the economy, then more people have got more money to spend on goods, and this pushes prices higher. Likewise, if borrowing is very cheap, the cost of credit is very low, then again, spending will increase rapidly. You can curtail the spending by increasing the cost of credit. Now, the aim varies from country to country. Some countries are specifically focused just on inflation, but ultimately each central bank will have a mandate, either set by themselves or by the government. And the mandate in some cases can be also to secure stable growth, also to lower employment, and again to focus on an exchange rate. So it varies country to country, and this is important when assessing each different central bank and where your trading opportunities are within them. So let's move on to the tools and how they actually implement these policies. The main tool for central bank is interest rates. Now, there's a couple of different interest rates they have. They will have a deposit rate. This is the rate that they pay out to institutions, this being commercial banks, that hold deposits with the central bank. Now, every commercial bank has to hold a minimum deposit, but this interest is then paid on anything above that minimum, any excess deposits that a commercial bank holds with the central bank. Beyond that, there is then a refinancing rate. This is the main rate that you usually hear of. Now, this refinancing rate is the rate that the central bank will charge banks to borrow money from it through its refinancing operations, these known as repos. We'll come on to those in a moment, so don't worry too much about that. But essentially, it is the cost that the bank charges to lend money out to commercial banks who want to borrow some money from it. So, how does this actually change anything? The refi rate is then passed on from the commercial banks to the consumers. So, if the central bank increases the refi rate, the refinancing rate, then it becomes more expensive for the commercial banks to borrow money from the bank, and therefore they need to pass this cost on, the same as you would in any other business. If your cost of coal that goes into your production goes up, then you increase the value of the end product. So that's how refinancing rate works. Likewise, if they reduce it, then the commercial banks don't need to charge as much interest on loans, and therefore can give out more loans, or they will be taken up more readily. Next up, deposit rate. This works in a slightly different way. If the central bank drops the deposit rate, what it does effectively is makes it worthless to hold deposits at the central bank. So any commercial banks that are just storing cash at the central bank and taking a small amount of interest on it will then feel that they need to use that money more wisely, and they'll start lending it again. So this again increases lending. Now, in the case of the ECB, the European Central Bank, they've actually got their deposit rate at negative 40 basis points, which means banks are actually charged to hold deposits with the ECB. Therefore, theoretically, they should be more willing to lend that money out, because any interest is better than actually paying to hold your money at a bank. Now, as I've just mentioned in this summary really, cost of credit does adjust the propensity to borrow and thus the propensity to spend. So controlling the cost of credit does directly affect inflation. So that's the idea behind monetary policy as a tool. After interest rates, the central bank will also look at adjusting the money supply. This is an ongoing process, and it's done through open market operations, or refinancing operations as they're known. Now, the idea of this is to tweak the amount of money in supply in the economy. It's not sort of a wholesale longer term thing, just a short term thing. And also, as we spoke about earlier, changing the amount of money charged on loans, or changing the amount of money around, can affect shorter term interest rates. So that's the idea as well, to maintain an interest rate very close to a certain level that they want, i.e. the refinancing rate. So first up, you have a repo. This is a refinancing operation. What happens here, the central bank will buy bonds from commercial banks, thereby giving them more money and the ability to create more loans, creating more supply of cash in the economy. The opposite effect is a reverse repo, whereby they will then sell the government bonds back, taking money away from the commercial banks, so reducing their reserves, reducing their ability to lend, and so reducing the amount of supply of cash in the economy. Now, next up, you've got a reserve requirement. This isn't often changed, but what it serves to do is it maintains that banks have to hold a certain amount of money at the central bank. Reason for this is the fractional reserve banking system. So commercial banks have to hold a certain amount of money at the central bank. This amount is a percentage based on the amount of deposits that the commercial bank has taken on. So this is all the deposits from you and I who hold money at our bank. So they have to keep a percentage of that at the central bank. After that, they can lend the rest out and create more and more loans with it. So therefore, if a bank increases the reserve requirement, they have less of that money to lend out, and so reducing the amount that they lend, reducing money supply, but also the bank, because they're lending less, will ask for a higher interest rate for it. Now, I've got a little table here of how the fractional reserve banking system works. Essentially, you put 100 quid in a bank, say the reserve ratio is 10%, the bank can then lend 90 of that. They lend the 90 to someone else, who then spends it with someone else. That person puts it back in the bank. The bank can then lend 81 of that 90. They just keep the £9, keep the £9 as reserve, lend the 81. The 81 gets spent, and then whoever gets the money puts it in the bank, and this continues around and around and around. And this is how credit can actually get boosted without actually any more money in the economy, known as credit creation. So that's what the central bank is seeking to adjust by moving the reserve requirement around. Extraordinary measures. These have become a lot more common since 2008. The idea being to use different measures to stimulate the economy rather than just the more rudimentary measures of reducing interest rates as a stimulus option. So what did these include? First up was QE. This all started with the Fed. It's similar to something that had been done in the Depression, and Ben Bernanke, the head of the Fed at the time, was a big scholar of the Depression era. And so the idea was that the central bank would basically print more money and buy government bonds in either the secondary market or directly from the government. What this serves to do is drive up prices of government bonds, thereby reducing yields. And so this has a knock-on effect to borrowing costs in general, how much new bonds will then be priced at. They'll be priced closer to the current yields as opposed to the older ones. It increases the amount of money that banks then have as well, because they can sell their bonds, so they've got more money, increasing their ability to spend, their ability to pump money into the economy. And the aim is essentially to maintain inflation up so we don't get into a deflationary spiral where prices drop, wages drop, prices continue to drop because wages have dropped, and so on and so on and so on. So that's the idea of QE to start with, QE otherwise known as quantitative easing. Now, this then progressed into QE expansion. Different countries took it in different ways. We've had corporate bonds included. It initially was just government bonds, which is seen as the most safe, but then we've had the idea of buying corporate bonds with the aim to reduce borrowing costs for companies directly, rather than the money that is being spent on the government bonds ending up just sitting with banks and not actually going anywhere. So the idea is to try and drive down corporate bonds yields thereby increasing the propensity of companies to spend and therefore employ more and more people. Beyond that, you've also had the Bank of Japan, who's extended further into buying other assets. They actually now buy ETFs as well, so that is essentially directly buying stocks. So that's been the expansion. It has varied from country to country. It has varied in time as well. Bank of Japan, once again, have been something of a pioneer of the most extreme of the extraordinary measures, and they have gone into a situation of indefinite QE. So there will be no, at the moment, stopping of the amount of bonds that they're going to be buying. Beyond QE, you had Operation Twist. The idea of this is more to affect the housing market and longer term borrowing, because mortgages, for example, are a much longer term product. Then they're priced more off the longer term bonds, so your 10-year bonds, etc. Now, Operation Twist, what the idea there is to shift from buying shorter end 2-year, 1-year, 3-year bonds, shift the money you're spending there into the 10-year bonds and later, thereby dropping interest rates in the longer end, which is what mortgages are priced off. So that was part of the idea of Operation Twist. You've then got, and this is an ECB initiative, an LTRO. This is a long-term financing operation, or long-term refinancing operation, I should say. Similar to a repo, but it's done for a longer period of time at a lower rate. So a bank can sell their high-grade collateral to the ECB for funding for a much longer period of time. This is sterilised. What I mean by sterilised is the agreement, like a repo, is that at some point in the future, the bonds will switch back, the money will switch back. So it's not an indefinite buying of the bonds in the case of QE. So this was the initial idea behind the ECB's LTRO, as opposed to going straight in with QE. And finally, there is helicopter money. Now, this is something that has been talked about, but what you will find in financial markets is if something does start getting talked about, eventually some form of it may well end up happening. This has happened with the ECB saying that QE is absolutely off the table. It's not something that's possible to do inside the European Constitution. Didn't happen. Eventually, we did get QE. So keep your eyes out for helicopter money potentially in the future. This will likely come in the form of a perpetual zero coupon bond. Now, what this means is it's a bond that pays zero interest, so has no yield, and also has no maturity date. So there is no time in the future that if you buy this bond, you will get your money back. So essentially, you are given an indefinite loan for 0%. So you are basically handing money over, as opposed to the more, and where the term comes from, helicopter money idea of literally dropping money to the public. So everyone suddenly gets their bank account credited with a certain amount of money. So this probably is some way off, but some form of helicopter money could eventually become a possibility as time goes on. So do watch out for that in future. Right, I'm just going to give you a brief sort of fact sheet run through of the major central banks that we're going to be talking about, so you know main things that you need to be looking out for, listening out for. So Federal Reserve, this is the US's central bank. It's made up of 12 regional reserve banks, but essentially the deciding members are the FOMC. This is the Federal Open Market Committee. Made up of the board, which is 7 members, one of which is the chair, along with the head of the New York Federal Reserve Bank. They're a permanent member. So you've got the 8 members there. The other 4 come from 4 of the remaining 11 reserve banks, so heads of those banks that create the full committee that makes the decisions. The other heads are still around. They're in on discussions, but ultimately they don't decide the final result. Moving on, what do they decide on? they decide on the discount rate. This is the amount charged for emergency lending to banks if they come under a slightly sticky situation in terms of liquidity. That's the interest rate that they pay on emergency lending, very short-term lending. Not often used, but is something that they will set. The next big thing is the Fed funds rate. This is the one to be listening out for. This is the one that changes, that the market is focused on. The Fed gives it as a range, usually a 25 basis point range. And the aim of the open market operations, the repos, reverse repos, is to maintain the interest rate within that range. Also, the top of the range is the IOER. This is the interest paid on excess reserves held at the Fed. It's basically a deposit rate. So any excess reserves you hold at the Fed, they will pay you an interest rate on that. So that is the top end of the range for the Fed funds rate. Next up, meetings. What they have is 8 meetings a year, roughly 6 weeks apart. Every other one of these meetings, you get a press conference from Janet Yellen, who is the current chair. You also get staff economic projections, SEPs. These are projections for year end for the next 3 years, and projections on inflation, unemployment, and GDP. So that's what you get out of the Fed every other meeting. And they're usually the ones when, if there is going to be a decision made, that's when you'll get the decision. Next up, you do get the minutes 3 weeks later. These tend not to be as influential on the markets, but can sort of just add a little bit of clarity if there hasn't not been enough. Finally, the Fed does have a dual mandate. Firstly, it has a mandate of maximum employment. This doesn't mean everyone in the job, but a maximum level of employment that is aimed for. As we mentioned before, there is things like frictional employment that you can't do anything about, frictional unemployment, I should say. So it has a maximum level of employment to aim for, and also a mandate to maintain stable prices. These were clarified in 2012, stable prices meaning somewhere around about 2% inflation. Next up, we've got the ECB. Their decisions are made by the Governing Council, which consists of 6 permanent members and then 15 of 19 of the heads of central banks from around Europe. They're on a rotational system, so the importance there is knowing who is actually voting this month. When I say voting, you don't actually ever see the vote. The decisions are made by consensus, so you will just be told whether the decision was unanimous or not generally. They end up deciding on the refinancing rate. This is the rate that they use on their repo operations, and so the rate they use to influence how much interest the banks will then be charging to their customers. Next up, the deposit rate. This is the amount paid out to banks holding deposits at the ECB. Currently, that is in negative territory, so trying to encourage the banks to take money out and lend it to the wider economy. And finally, you've got the marginal lending facility. This is much like the Fed's discount facility, where they will lend short-term emergency funding at the marginal lending rate. They've also got non-standard measures. These are in the form of the Asset Purchase Programme, which consists of the PSPP, the Public Sector Purchase Programme, and the CSPP, the Corporate Sector Purchase Programme. So they're the 2 main programs, and in the announcement of rates, they will also announce how they have adjusted those, if they have at all, and the duration that they will be lasting for. You've also got a TLTRO, targeted long-term refinancing operation. As I mentioned, this in the extraordinary measures is an extension of that, and so it is longer term lending at a lower fixed rate. And their meetings and decisions, you get 8 meetings a year, 6 months apart again. Minutes are released 4 weeks later. The ECB minutes are generally very limited in the amount of influence they have on the markets. Then they don't offer a great deal that you won't have already learnt in the press conference. Now, what you get is you get a 12:45 announcement of rates, how the rates have changed or what the current rate is going to be, and you then get a press conference with a Q&A with the head of the Governing Council at 1:30. This is where you get the rest of the information. Recently, we have been seeing information come out at 12:45 as well, so you do sometimes get a dump of information there. But that's the ECB. They're the things you need to be looking out for. Finally, Bank of England. They have got just 9 members on the MPC, the Monetary Policy Committee. They take the decisions on rates. This is made up of 5 members from the bank and then 4 appointees from the Chancellor, so government appointees. They each have an equal vote and the majority rules. So unlike the Fed and the ECB, you do actually get to see the vote. So you get to see whether it was a 7-2 vote, a 9-0 vote, a 5-4 vote. So you would always get that clarity. What do they decide on? They decide on the bank rate. This is the Bank of England's main refinancing rate. It's what they charge banks for overnight loans in their open market operations. Beyond that, like the ECB, they do have some non-standard measures still in place. This is the asset purchase facility. This is the Bank of England's QE facility where they're buying government bonds. They have also expanded this recently into corporates as well. Beyond that, they have also got an FLS. This is a funding for lending scheme. The idea of this is that they will guarantee funding to banks if the banks are guaranteeing to be lending this out to the wider economy, particularly in the form of housing loans. Finally, they have 8 meetings a year, just like the Fed and the ECB, and just like them, they are staggered in that every other meeting you get the decision plus the minutes, and then the other meetings you get what is called Super Thursday now, whereby you have the QIR, the quarterly inflation report, the decision, the minutes, as well as a press conference. So that's the big one, and again, that's usually the one where you get any decisions made. Finally, the mandate. The Bank of England, just like the ECB, has a mandate of inflation. Unlike the ECB though, the Bank of England's mandate is to remain near the government's target of 2%. That is the current government's target. The government can change the target, and the target is also symmetrical, so it is seen as just as bad to be above the target as it is to be below, rather than the ECB is more aimed at below but close to 2%. So there is an implied asymmetry there, that going above it would be worse than staying just below. So that's the Bank of England. We'll move on now onto where the trading opportunities are.